Hey everyone, welcome back to Corporate Decoder, the place where we decode the financial jargon and give you the real story. A bit of a heads up, this report might make you feel like you need a financial advisor on speed dial because we are diving into some serious borrowing power. Before we dive in, if you love getting these unvarnished looks into company dealings, hit that subscribe button and ring the bell so you never miss out. We also have a fantastic community over on Discord where we discuss these filings and more. You can find the link in the description below, so join us there. Alright, so today we are looking at a Form 8K filed by KKR Incorporated. Now this isn't their big quarterly financial report, but it is a crucial notification of a significant event. Think of it as a company announcing something important happened that the public needs to know about right away. Right off the bat, we see the company is KKR Co Incorporated. A big name in investment and finance. They are incorporated in Delaware, which is pretty standard for large companies, and they have a commission file number and an IRS employer identification number. All the official stuff you'd expect from a publicly traded company. Looking at their registered securities, we see their common stock listed on the New York Stock Exchange under the ticker KKR, but they also have preferred stock and even some subordinated notes. This tells us KKR uses a variety of ways to raise money, not just by selling ownership stakes. The specific Series D mandatory convertible preferred stock is traded under KKR PRD, and their subordinated notes are under KKRs and KKRT. Now for the meat of the report, the part that explains why they are filing this 8K. This section is all about a new financial arrangement they've entered into. Specifically, it covers the creation of a direct financial obligation, or an obligation under an off-balance sheet arrangement for the registrant. On the 16th of January of 2026, some entities related to KKR, specifically Global Atlantic Limited and Global Atlantic Finance Company, along with their insurance subsidiaries, entered into a significant credit agreement. This sounds complicated, but essentially it means they took out a big loan or set up a borrowing facility. Wells Bank NA is acting as the main bank managing this deal. What kind of loan are we talking about? It is an unsecured revolving credit facility. Fancy words, right? Let's break it down. A revolving credit facility is like a credit card for giant corporations. They can borrow up to a certain amount, use it, and then pay it back and borrow it again. It is not a single lump sum loan. And unsecured means they are not putting up specific assets as collateral. It is based on their overall creditworthiness. As of the 16th of January 2026, this facility is set at a massive $3 billion. But they can actually ask for an extra $500 million, bringing the total potential borrowing to $3.5 billion. That is a lot of money. This particular loan facility is set up for a short term. It is a 364-day facility, meaning it is scheduled to be paid back or renewed within a year on the 15th of January 2027. However, and this is important, they have the option to extend it for another year or more as long as the lenders agree. The good news for KKR is they can pay it back early or reduce the amount they are committed to borrow without any penalties. This gives them a lot of flexibility. So what is this enormous sum of money for? They can use it for working capital, which is essentially the money they need to run their day-to-day operations. It is also for general corporate purposes, anything the company needs to do to keep running smoothly, and importantly, for growth initiatives. This suggests KKR plans to use this funding to expand its business, perhaps through new investments, acquisitions, or developing new services. Now let's talk about the cost of borrowing this money. The interest rates are tied to either the secured overnight financing rate, also known as SOFR, or an alternate base rate. The exact rate they pay will depend on KKR's corporate credit rating. For SOFR, the interest will be SOFR plus a margin that can range from 1.10% to 1.375%. If they choose the alternate base rate, it will be that rate plus a smaller margin from 0.10% to 0.375%. They also have to pay a commitment fee on the money they are not actively using. This fee ranges from 0.125% to 0.225%. These are actually pretty competitive rates, especially for such a large amount of unsecured funding. It indicates KKR is seen as a very low-risk borrower. Now, every big loan comes with strings attached, and this one is no different. There are financial covenants. These are rules the company must follow to keep the loan active. For Gold and its subsidiaries, they must not let their debt to total capitalization ratio go above 35%. That means the total amount of their debt cannot be more than 35% of their total capital, which includes debt and equity. They also have to maintain a certain level of net worth. This net worth must be at least 70% of what it was at the end of 2023, plus 50% of any profits they have made since then. These covenants are designed to ensure the company remains financially stable and can repay the loan. Besides the financial specifics, there are also customary representations, affirmative covenants, and negative covenants. These are also pretty standard for large credit facilities. They include things like promises about the accuracy of information provided, limitations on taking on more debt to a certain extent, and restrictions on certain types of transactions like dealing with affiliated companies or making drastic changes to their business. These are all about managing risk for the lenders. And of course, there are events of default. If KKR or its related entities breach any of these terms, the lenders have the right to demand all outstanding loans be paid back immediately and cancel any remaining commitments. This is the ultimate protection for the lenders. So what does this all mean for KKR and for us watching? This is a sign of KKR's strong financial position. Securing a $3.5 billion unsecured revolving credit facility with flexible terms at competitive rates suggests that major banks like Wells Fargo view KKR as a reliable and low-risk borrower. The funds are earmarked for working capital, general corporate purposes, and growth initiatives. This tells us KKR is confident in its future and is planning to deploy capital for expansion. Whether this means further acquisitions, private equity investments, or growing their asset management business remains to be seen. But this facility provides them with significant dry powder. The covenants mentioned are fairly standard and indicate that KKR is committed to maintaining its financial health and a healthy debt to capitalization ratio. This transparency is good for investors as it shows the company is being managed with a long-term perspective. Overall, this filing is not about a sudden financial crisis or a major setback. Instead, it is a proactive move by KKR to ensure it has ample liquidity and financial flexibility to pursue its strategic objectives. It is a sign of strength and a well-managed financial operation. Now, looking at this report, I think it really highlights KKR's strategy to maintain significant financial flexibility. They are not just raising money, they are ensuring they have reliable access to capital at good terms. This is crucial in the investment world, where opportunities can arise quickly and having the funds ready to deploy is a major competitive advantage. The fact that this is an unsecured facility of this size is a testament to their established reputation and their robust underlying business. The risks here are relatively low in the context of this specific filing. The main risk is always that the investments KKR makes with this capital do not perform as expected, but that is inherent in their business model. The covenants in place are designed to mitigate lender risk, not necessarily company risk directly. However, adhering to these covenants ensures the company remains in good standing and can continue to access capital. In conclusion, KKR is demonstrating its financial strength and strategic foresight by securing this substantial credit facility. It positions them well for future growth and opportunities in the dynamic investment landscape. It's a solid move that signals confidence and capability. Alright, that is our breakdown of KKR's latest filing. What is your take on this borrowing power and what it signals for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.